We think the start of the big sell-off is skepticism. Skepticism coming out of the bond market, as talked about yesterday, the belly of the curve inversion. That skepticism came through the trade discussion today. The Fed, to our knowledge, really hasn't come in the discussion today. What we do think, what we would say, is the yield curve inversion in the belly of the curve is somewhat of a warning shot or a test for the Fed. You know, we've had a ceasefire this week. We would say that's more of a warning shot to the Fed to see what they're going to do and what they're going to say on the 19th to follow this more dovish language we've been hearing.
You know, Steve had mentioned the times when the yield curve inverted and how many months afterward a recession follows. But I want to know what happens with the stock market in the months after the yield curve inverts, because I hear that it's 6 months that the markets can still go higher after an inversion.
Yeah.
And what do we consider an inversion? Is it 2s, 10s? Is it 3s, 5s? Because 3s, 5s we've got right now.
Yeah. Well, the studies are with 2 and 10s. But
Yeah.
if you look at it, a flat yield curve does not bring a lower stock market. And that we saw that not in the 1990s, we saw that in the 2000s, we saw that in the 2010s. So I personally am not that worried about it. I guess I would say to Steve, why is it remarkable that the bond market is signaling some kind of recession when we've had 9 years of economic expansion? Wouldn't we statistically expect that? And is the market overreacting a little bit at this point? Wouldn't you expect some kind of economic slowdown that borders on a recession by 2020, which is what this has been saying, the numbers you were just showing us?
I don't think thinking about or forecasting a recession in 2020 is worth anybody's time.
Yeah.
Right? And I don't think the market forecasts. I know that I'm trying to figure out where I'm going to be tonight, rather than what the market or the economy is going to do. We're going to have a good old time. But the issue here is it's a signal that you have to take seriously. I will say, I didn't get a chance to say this earlier, there are some technicals involved here. There are pension funds that came in. Apparently, some big Asian buyers came in as well. It's year-end stuff. It seems like every year I have to remind people that at the end of the year, you have the year end.
By the way, this may salvage what's been happening in the bond market. We were going to have a down year. People were going to look at those statements and go, oh, my God, I lost money in bonds, and now you maybe have to take that off.
So I don't think it's going to be quite as bad as it seems right here. I would watch it carefully. The reason why it happens is unclear to people, but it does a very good job. And Bob knows better about how stocks work.
Yeah, I think if you look at the 3 things the market cares about, number 1, the Fed and raising rates too aggressively. That concern is somewhat lesser. Number 2 is tariffs and a trade war. To the extent that the president's team has indicated they want to negotiate, I would say that's a little bit lesser, but still on the table. The third thing is global growth and U.S. growth. And I think that's what they're saying right now. That's the clear issue.
But Paul,
they're concerned about somewhat slower global growth.
Going back to the point that Melissa just made, which is, all right, fine. So the yield curve is flattening. So we're talking about a slowdown in some period of years ahead. If people are worried about a 20% stock market sell-off and we rally 20 or 25% before that happens, what are we talking about? What are people supposed to do?
Well, people are supposed to realize, to go back to Bob's point for a minute, this is still a pretty flat yield curve. To get a really significant inversion, we found our research, you need to have a sustained at least 4 weeks inversion. And we like 10s to 2s. We also watch 10s to 1s. We find that to be a very good predictor, too. Fewer false signals. And what you're still looking at here, we think, is a very flat yield curve. There's this incipient emerging slowdown in the economy. And did you know there's been 24 corrections in the market in the S&P since 1959, and in almost all of them, there was already a slowdown in place. We think what you're seeing right now is a slowdown. The market has already picked it up in October.
A growth slowdown?
A growth slowdown, and the bond market is now picking it up, too.